everyone, and thank you for joining the Consistent Compounders webinar. We have with us Rakshit, and Saurabh is also joining. We will follow our usual process of conducting the webinar, which is Rakshit, Saurabh to give us an update on the fund, and I will also request them to share their initial thoughts on our latest CCP newsletter, which we published earlier this month, studying the holiday schedule of Consistent Compounders share price. Now, after their initial thoughts, we will open the house for Q&A. Request all of you to please keep posting your queries on Q&A box. Rakshit, floor is yours. Rakshit, Saurabh, floor is yours.
Thank you, Nitesh. Hi, good evening, everyone. Thank you for logging in. So let me, one second. Hardik, can you enable screen sharing for me, please? Yeah, thank you.
Done.
Okay. All right. So, it's volatile times. It's turbulent times in the stock market. From October to March, there was a period of sort of market delivering broadly, not much, and we underperforming by a good 6-7 percentage points during the 6-month period from October 21 to March 31. Last month there was a little bit of 2 percentage point alpha, and last couple of days of this month have again been quite volatile in absolute terms. So in that context, whilst we have discussed in the past the reasons why October to March there was an underperformance at the portfolio level, and I'll touch upon those reasons again as a summary towards the end of this presentation. But also it's worth understanding a stock specific level, stagnation in the share price as well, which is not necessarily just linked to the last 6 months, but in some cases has been ongoing for the last, say, 1-2 years. So for instance, an HDFC Bank, a Nestle, an HDFC Life, right? These are 3 examples from our consistent compounders portfolio, where not just in the last 6 months, but actually for the bulk of the last 1.5 year, we've had not much of performance of the share price for these companies, and hence valid questions have been asked by our clients around why do we stay convinced, and why do we keep holding on to these companies when the share prices haven't been performing, even prior to October 21, when the rest of the portfolio was delivering pretty healthy absolute returns. So in that regard, we thought it's best we answer this question by referring to some empirical evidence from historical share price performance of various companies in our portfolio, and we call it the holiday schedule. So let's start off with Asian Paints, right? This is a chart showing the last 12 years of share price trajectory of Asian Paints. Now, point to point, as in Jan 2010 to April 22, Jan 2010 to April 2022, Asian Paints has delivered a share price compounding of 26% CAGR, and hence anybody looking at this chart in hindsight would have called it a great and consistent compounder, and would have been very comfortable holding on to the stock in the portfolio when this stock delivered 26% annualized rate of compounding over a 12 year period, right? Effectively becoming 10x in 10 years at a 26% CAGR, and that run rate has been displayed on this chart over the last 12 years. But having said that, there were these 3 encircled periods over the last 12 years, where for a good 1.5, 2 year period, Asian Paints' share price didn't do anything, right? So would you have been questioning the investment in Asian Paints at that time if you were a shareholder? Depends on what was happening behind the scenes. If behind the scenes the fundamentals were weak, then probably without any foresight on how the share price chart is going to progress, you should have been worried. if behind the scenes the fundamentals were progressing really well, then despite the stagnation in the share price performance of Asian Paints over these 12, 15, 18-month periods, you should have been quite comfortable. So that's the broad theme of the three bubbles, and let's go through them maybe one by one. So this is the first instance where between July 10 and December 11, the concerns that investors had when the share price delivered zero were around, first and foremost, massive input cost inflation and its impact on margins. If you remember, between July 10 and December 11, crude oil prices more than doubled, right? Not only did the prices double, TiO2, titanium dioxide, which is one of the largest raw material inputs into paint manufacturing processes, TiO2 underwent a massive shortage of supply. That was in addition to overall raw material cost inflation, right? And in order to offset these types of procurement challenges, what Asian Paints did was, for 2 consecutive years, they hiked their product prices by 12 to 15% each. And these were FY11 and FY12, 2 consecutive years. They hiked product prices by 12 to 15% each. And the concern that investors at that time had were that, will this not lead to a moderation in volume growth, because there is price elasticity of demand once the price increases are of disproportionately higher degree, such as a 12 to 15%. Remember, over the last 25 years, annual average price increase taken up by Asian Paints is only 2%, right? Against a 2% 25-year average, during those 2 years, there was a 12 to 15% price increase annually taken, right? So those were the concerns. The share price didn't do much. In fact, behind the scenes, if you had peeked into the fundamentals, they had a massive sort of 18-20% CAGR in the dealership count expansion. At the same time, a massive automation of the manufacturing plants was underway, which in hindsight now we enjoy, because free cash flow compounding of Asian Paints as a result ended up being significantly higher than even the rate of revenue growth or profit growth. And all of these investments were not only in the back end, there were several tech investments being done around Salesforce automation at the front end as well. And they were the first of their kind in the industry at that time, and quite disruptive in that regard. As a result, had you been holding on to Asian Paints during that time, in the next 12 months, after this holiday period of July 10 to December 11, in the next 12 months, Asian Paints delivered an absolute return of 70%, 70, right? So after the 259 rupee share price that you see in December 11, the calendar year 12 saw a 70% increase in the share price of Asian Paints. Effectively, the stock caught up on the sluggish share price performance period, and it caught up with the fundamental progression, right? So that was the first example. Second time it happened, this was more around Jan 15 to April 16. The concerns here were that there were 2 consecutive back-to-back weak monsoons that India had seen, and that was affecting consumer demand across all sorts of sectors, including home building industry, right? Home building materials industry. And the concern was, will that affect fundamentals of Asian Paints adversely or not, right? At the same time, crude oil price had started falling. Now, intuitively, you would have thought, if crude oil price was falling, investors should have been happy about margin expansion. But here, Asian Paints, in order to not leave any room for competition to get a breathing space, Asian Paints took chunky price cuts in FY16, and those price cuts led to investor concerns around whether Asian Paints does have any pricing power to hold on to expansion in margins when input cost deflation is the ongoing phenomenon, right? So that's that's in effect the reason why the share price didn't do much during that time. But behind the scenes, again, massive dealer network expansion, massive investment in technology, and launch of a very disruptive concept, which today has started picking up pace around home decor, around AP Homes as a retail network, so on and so forth, right? So the company was not getting worried. Management was not getting worried about any pricing power oriented piece about related to their price cuts or monsoon demand after weak monsoon, etc. If you held on to Asian Paints during this time, in the next 12 months, the share price delivered more than 30% return, right? After this 866 point, in the next 12 months, the share price delivered more than 30% return and caught up with fundamentals again, right? Likewise, for the GST period, right? May 17 to April 18. And remember, Asian Paints has been at the center of GST as a new disruptor, because kache mein bill bana ke dealer would be selling paint prior to GST to the contractor or the painter, right? वो कच्चे में bill वाला transition into all being a formalized economy at the front end, formalized distribution network at the front end, was a massive concern. Along with that, crude oil prices were rising. They again doubled. Crude oil prices doubled roughly around this period. And JSW Paints announced their entry into the paint industry with a new concept of a single price point, several SKUs, so on and so forth, right? So from a variety of angles, there were investor concerns. And during this 12-month period, there was no share price movement at all, right? At that time, we were running at a different platform. We were running a PMS, and Asian Paints was one of the larger holdings, and this share price didn't move in that PMS, right? Behind the scenes, massive expansion of capacities was underway. They nearly doubled their capacity through the launch of Vizag and Mysore plants. They entered into putty, waterproofing, in a way, gave the cement companies head-on competition in putty industry, gave Pidilite, Dr. Fixit, a lot of competition in the waterproofing industry, and gained a lot of market share in both of these new segments thereafter, including in decorative paints. What would have happened had you held on to Asian Paints after the holiday period got over? The share price delivered a 111% absolute return in the next 3 years, right? In the next 3 years, delivered a 111% absolute return, right? That's more like a 30% CAGR, right? And again, more than catching up on the lost momentum during May 2017 to April 18, right? Likewise, now I'll go a little faster. Probably you've got the theme, what's playing out here. Dr. Lal Path Labs, after its listing for the first 3 years, delivered a holiday to its investors, right? Absolutely no progression in the share price. But behind the scenes, they managed to massively avert a price war from Thyrocare and still continue growing in NCR region, and expanded into the Eastern Territory, which today has become a very formidable, profitable part of Dr. Lal's overall portfolio. And it has de-risked Dr. Lal from being only North India exposed, right? That was what Dr. Lal was doing when the share price was not doing anything. It was as long as almost a 3-year period, right? But once that 3-year period was over, Dr. Lal delivered an annualized return of 80%, right? In the next couple of years, right? So that's how these share prices, they catch up with the lost momentum, and including the recent fall of Dr. Lal, point to point, this chart has delivered more than 20% annualized return, right? So including this fall of the last 6 months and including the stagnation of 3 years, in the last 6-year period, Dr. Lal's share price has had a more than 20% annualized return. That's the reward for holding on to it. If you couldn't time the entry exit precisely, right? This is Pidilite, very similar to Asian Paints. 2 periods of stagnation when Asian Paints also saw a similar piece where, first of all, there was massive raw material cost inflation in FY12. Pidilite also hiked prices. Behind the scenes, the company did a complete transformation on tech investments and massive product launches. And you can see what happened to the share price from 167 in July 12. The share price moved on to 600 by Jan 15. Right after a period of stagnation, the next 3 years saw a 4x increase in the share price. Right, that was followed by another period of stagnation. Similar reasons where volume growth had slowed down because of a couple of weak monsoons, right? And there was also the concern around pricing power, because Pidilite also took price cuts when crude oil price fell during this period. But massive work being done behind the scenes. Once the holiday period was over, you can see what happened after 603 to the next 3-4 years of share price trajectory, right? Exponential in a way you can put it. So this is what happens. Just to remind people that this is not just the last 10 years. Even in the preceding decade, as in 2000 to 2007, before the global financial crisis, we used to see this sort of a phenomenon. This is HDFC Bank. For 3 long years, there was zero share price return, right? In fact, negative 3%, as the chart shows. Despite the fact that over this 3-year period, profit after tax of HDFC Bank, it compounded at 48% CAGR, right? Once the holiday period was over, HDFC Bank's share price delivered a 42% CAGR in the next 3 years, and hence more than caught up with the sluggishness reported during the holiday period, right? So that's what keeps happening. Right now, as I mentioned previously, we've got 3 stocks in our consistent compounders portfolio where, even if you ignore the last 6 years of overall sort of sluggish return for the portfolio as a whole, these 3 stocks in particular have had a longer than 12-month holiday going on at the share price level. The concerns are different for different companies. For Nestle, the concern is, well, the input cost inflation, what does it do to margins? Volume growth is coming in Maggi, in chocolates, but it is not coming in baby foods for the last couple of years. What are we heading towards when baby foods is more than half of the portfolio for Nestle in profit terms, etc. But when you look at behind the scenes what Nestle is doing, there's a massive expansion of distribution network. There's more than 4 percentage points to sales equivalent reduction in expenditure, and hence operating efficiencies which have been derived in the last 3 years, right? So this is roughly 150 bips EBITDA margin support from operating efficiencies annually in the last 3 years through sweating the assets harder, and a lot of systems and processes being put in place by Suresh Narayanan's management team at the ground level on the front end. And very recently, they commissioned a state-of-the-art manufacturing plant where productivity is 20% higher than their other plants in the rest of the country, and hence asset turns are rising. Hence, free cash flow is not so much of a concern, although revenue growth has been only 10, 11, 12% over the last couple of years, which perhaps is putting an overhang on the share price. HDFC Bank, some of you might know, the common reasons why people are a little worried on HDFC Bank is the mobile application crashed a couple of times last year. There was a leadership change, I think 18 months ago. There was a recent quarterly result announcement when net interest margins saw a little bit of moderation, etc. But behind the scenes, we see HDFC Bank significantly gaining market share around both loan book as well as deposits, and profit after tax compounding at a very healthy pace with one of the leading returns on equity amongst lenders, especially amongst banks, of this bank being maintained, right? And hence, this is not a company which has gone through a stagnation in fundamentals. It's just a stagnation in the share price. Likewise for HDFC Life, right? You can read the text here, massive fundamental progression, but the share price hasn't done much, right? Now, The only thing that we've not addressed in this sort of narrative so far is that somebody might be questioning that every time, is it possible that the stagnation happens because of overvaluation? That the stock becomes so richly valued that stagnation is around the corner. Can't we do something about it? Can't we exit when stocks become overvalued? Now, if they were becoming overvalued, we would be concerned. But I think in the last webinar, we explained this chart in particular in greater detail. I'll summarize it here. When you look at the price to free cash flow multiples over the last 7 years for these companies, there has been no expansion in the price to free cash flow multiples here. These companies have not seen any increase in their valuation metrics, provided you're looking at the right metric, over the last 6 or 7 years. Where they have seen an expansion in valuation metrics is if you do PE multiple, price to earnings, right? But because the earnings growth of these companies tends to lag behind free cash flow growth by 5-6% in every 5, 10, 15, 20-year time period historically, the PE multiple obviously sees the numerator being driven off free cash flows, because that's the only way valuations get defined, whereas the denominator is driven off earnings, and earnings lag behind free cash flow compounding by 5-6% consistently as working capital cycles keep going down for these companies, asset turns keep going up for these companies through technology investments that they do to make the business a lot more efficient, right? So it is not the case that FY21, which is the end point of all of these charts, it is not the case that FY21 had been a time period of or a time stamp of overvalued share prices, because of which over the last year and a half, the likes of Nestle, HDFC Bank, HDFC Life, and many other companies have sort of they can be blamed to have gone on a holiday for some time, right? So that's what's happening on the valuations front, and hence this is the performance. We are not worried because the underlying fundamentals are healthy on an absolute basis. Clients who've stayed with us for 1 year, 2 year, 3 years since inception, they would have got a very healthy return for every such time period, right? Including the last 1 year, 15% after the recent sort of underperformance is not a bad outcome in an absolute manner. And when it comes to the underperformance of the last 6 months particularly, so this is an updated attribution chart of Nifty. Again, just to summarize this point, which we made in some of our previous presentations, when you look at the Nifty 50, half of Nifty 50 has seen stocks do 12, 15, 20, 30% increases in the share prices over the last 6 months. And all of these stocks which have delivered great results in their share prices over the last 6 months have been in commodities and utilities. Right, PGCIL, Adani Ports, Coal India, NTPC. These are not the kind of companies that we would want to own in our consistent compounders portfolio, because their fundamentals do not compound consistently. They don't have a high pricing power which can deliver sustainable greatness and sustainable high free cash generation over longer term. And hence, even in hindsight, we wouldn't have done anything different to have got these stocks into our portfolio. Any mediocre or higher quality fundamentals would be sitting in the chart on the left at the bottom half, delivering a negative share price return, which is what has led to the, I think 300 basis points, 340 basis points of negative alpha that you can see here, where in the last 6 months, we've delivered -6% versus Nifty of -3%. Right, so the 3% negative alpha that you see is largely all because of utilities and commodities doing well in the index, which are not the kind of stocks that we would like to hold in our consistent compounders portfolio. So and yeah, this is a quick summary again. Not the first time that we are going through this sort of a phenomenon. Demonetization period was very similar. It's the same list of Hindalco, GAIL India, Tata Steel, ONGC, NTPC, which led to Nifty delivering a 8%, 9% better performance compared to our portfolio weighted average for a very similar type of a mix stocks doing well or not doing well in the broader market. The demonetization period was temporary, and we believe this last 6-month period is also temporary. And since the underlying fundamentals are compounding at actually an accelerated manner compared to what they used to previously, we are quite comfortable and confident of holding on to these companies and compounding the wealth of our clients through this portfolio. So I'll stop here and request Nitesh to sort of highlight any questions that we would have got.
Sure. Thank you, Rakshit. We already have started receiving a lot of queries. I will again request participants, if you have any queries, please feel free to type it out on Q&A box. So first question is for Saurabh. Saurabh, if you are there, if you can hear us.
I can hear you.
Yeah, hi Saurabh. So one of our participants wants to have your views on the current market cycle, credit cycle, and how does it impact the market, and also given the Fed is increasing the rates, how will it impact Indian equity market going forward?
So whilst I'm giving the response, Rakshit, given that you've got the controls, you might want to highlight the blog on the screen, which
Sure.
Nandita and I wrote about how rising rate cycles alongside inflation is actually good for consistent compounders. So just some data for people. In the last 70 years, since the Second World War, the Federal Reserve has gone through 12 rate hike cycles, right? So roughly every 6-7 years, the Fed goes through a rate hike cycle, right? And it's basically the decade-long economic cycle. So every 6-7 years, the Fed goes through a rate hike cycle. Nothing new there. A typical rate hike cycle is 2% to 2.5% rate hikes by the Fed. You will see that the data clearly shows that out of these 12 rate hike cycles, in the blog Rakshit is putting on the screen, you can access it on our website, marcellus.in, and the blog will have all of this data. In a typical, out of the 12 rate hike cycles the Fed has done in the last 70 years, in 11 of them, you had bull markets, right? 11 rate hike cycles out of 12, the market has been rising. Focusing specifically on the more recent rate hike cycles, there have been 2 rate hike cycles this century by the Federal Reserve, 2004 to 6, where the Fed hiked by 2% or 2.25%. In that 2-year period, the S&P 500 rose 50%, the Indian stock market doubled. And 2015 to 17, when the Fed again hiked by around 2.5%, and again the S&P 500 rose by around 50%, right, 50%. If you look at India, again this century, India has been through three rate hike cycles, and all of them have been accompanied by rising markets. So whether it's in America or in India, rising interest rates typically tend to be accompanied by rising markets, right? Not by falling markets, which is the narrative everybody and their mother father is convincing themselves about. Now, why does that happen? Why do higher interest rates lead to? Why are higher interest rates accompanied by rising markets? Typically, when the Fed hikes rates, they're doing so because economic growth is very hot. Economic growth is strong. As a result, the economy is overheating, and you have higher inflation. And the Fed's job, or the Reserve Bank of India's job, is to hike rates so that the economy cools down a bit and the economic upcycle lasts longer, right? Just to be clear, that's what central bankers are supposed to do. They're supposed to hike rates when the economy is overheating, take some steam out of inflation so that the economic upcycle lasts longer. That's what central bankers are paid a salary to do, and that's what they do. And because rate hikes therefore tend to be accompanied by rising economic growth, which is happening at the moment in our country, you'll see when the fourth quarter of FY22 GDP growth comes through, it'll be a strong print. The current quarter that we're living through is also a very strong print on GDP growth. You can see it in GDP growth, you can see it in corporate earnings. So typically, because rate hike cycles tend to be accompanied by strong GDP growth, you get pretty punchy bull markets when the Federal Reserve hike rates or the RBI hikes rates. So there's no great mystery there. Now, the next level of analysis is to say, what happens to high quality stocks, right? High quality stocks of the sort Rakshit has mentioned, What happens to these stocks when inflation is high, GDP growth is high, inflation is high, and the Fed is hiking rates? And this is where the table Rakshit has put on the screen will be very useful for you. So what we did was we looked at every single month in this century. We took 22 years of data, and roughly what we figured out was in 40% of the time period this century, in 40% of time periods, CPI inflation in India has been above 6%. So again, a lot of people mistakenly believe that high CPI inflation is somehow rare to India. It's not, right? By 40% of times, Indian CPI inflation tends to be above 6%. Now, what you can check, and this is simply looking at the data for the last 22 years, when CPI inflation is high, companies with strong pricing power obviously do better, right? So just to take an obvious example, if you have high raw material cost inflation, high CPI inflation, will an Asian Paints do better or will a chota company do better, right? Doesn't take a genius to figure out that the stronger franchise, whether it's an Asian Paints, whether it is a HDFC Bank, whether it is a Pidilite, whether it is a Titan, whether it is a Nestle, the stronger franchise naturally will have superior pricing power, right? And therefore, that's what you see on the screen. When inflation is high, when CPI inflation is above 6%, our type of companies, CCP type of companies, tend to outperform the Nifty on top line growth. They're basically passing on the input cost inflation better than a weaker company. They tend to do better than the Nifty on top line growth. Because they hike prices more, they tend to do better than the Nifty on bottom line growth, right? Operating margin improvements are, operating margin holds up better. And Rakshit, in his previous webinar, Rakshit showed you that Asian Paints' gross margins hold up beautifully when crude prices double, right? So strong companies, greater pricing power, greater defense of operating margins, and companies end up beating the Nifty through the course of high inflation periods, right? So the data is very clear, both at the macro level. If you're stressing out, if you're stressing about the market going into meltdown mode, we can't stop you from stressing, but we are paid to be rational, and therefore we are fairly relaxed about the fact that the Fed is hiking rates. We think the Fed is doing the right thing, the RBI is doing the right thing, and we have no reason to believe the sorts of companies we are investing in will fall apart. Obviously, there are in any country, in any bull market, you will have low quality companies that actually don't make any money. They pretend to make money, but actually they don't make money. They simply survive by raising fresh capital from investors. Those companies will suffer. Their share prices will fall. You will see bankruptcies from them. Promoters will run away. It's happened in America before. It will happen in America again. It's happened in India before. It will happen in India again. But I don't think those of you who are on this call invest in those sorts of junk stocks. You guys are investing in good quality companies, and economic growth is solid. Corporate performance is coming through. You see every day you can see corporate results coming through at a rock solid rate. So history suggests, common sense suggests, data suggests, current corporate results suggest that rising rate hike cycles, high quality companies tend to do very well.
Thanks, Saurabh. Rakshit, next question is for you. One of our participants is asking, how do we know the holiday period has started, and what should be our behavior, at that point of time, and also if there is any trend to know how long it will last.
Sure. So how do we know the holiday period has started? Well, we can know only in hindsight. It's very difficult to know about it in foresight that it is going to start tomorrow. We can only know in hindsight after a few months have progressed, where share price doesn't do much despite the fact that fundamentals are roaring ahead. What should we do during the holiday period? So I'll give you an example of what we've done in some of these cases. So as we showed that Dr. Lal Path Labs, and it's worth actually trying to live through that holiday period of Dr. Lal Path Labs. So many of you who were our clients back then as well, you would have experienced what I'm reflecting on here. For a good 3-year period, when we were managing money on behalf of our clients, Dr. Lal continued to be one of the larger positions in the portfolio. Everything else in the portfolio was tracking fundamentals, but Dr. Lal wasn't, right? And since this was one of the larger allocations, it kept putting a drag on the overall performance of the fund in a pro rata basis. Now, first of all, what we need to be all right with is that our fundamentals of Dr. Lal progressing well. That's the first point of action. We as investors, if you've given your money to a fund manager, then the fund management team. Otherwise, if you're doing it yourself, then you as investors, you have to dig deep into the behind the scenes activity happening around fundamentals of the company whose share price has gone on a holiday period. That's the first actionable that you have to think about. The second part is that because the stock is on a holiday, its allocation would have naturally gone down if the rest of the portfolio has been going up. In that situation, provided you are convinced on the fundamental progress, you should buy more of that stock, right? Because due to the holiday period, its allocation must have gone down in the portfolio, and that's an opportune moment to make an increase in the allocation in the portfolio, probably by shaving off a little bit of stocks which have gone up. We've done this in the last couple of months in our CCP portfolio with some stocks. We've done this 2 years ago through rebalancing of Bajaj Finance. We've done this during the Dr. Lal Path Labs holding period of 2017 to 2019 middle. Those 2.5 year period when we were managing funds on behalf of our clients and Dr. Lal was on a holiday period. You have to do this. You have to benefit from the opportunity. The benefit from the opportunity then happens when the holiday period ends and the stock catches up with fundamentals, because the higher allocation that you gave to that stock by buying more of it during holidays, it leads to a higher share price return. And hence, in the longer run, the kind of performance that we have, for instance, delivered in the fund, right? This since inception, 21.5%, 22%, the 3-year 23% performance that you see. This includes a 3-year holiday of Dr. Lal over the 3.5 year period. Needless to say, it also includes the last 1.5 year of holiday of HDFC Bank, Nestle, HDFC Life, etc., which I discussed. So rather than getting too worried about the holiday period, there are those two actionables that can actually benefit from the holiday period more. Understand fundamentals and buy more of the stocks which have been on holiday and you are convinced about the fundamentals.
Thanks, Rakshit. Another query linked to it, to the answer that you gave. One of the participants are asking, what do you do during the holiday periods to make yourself comfortable that these companies will deliver going forward in terms of fundamental checks? What are the things that you do?
Right. So, I mean, the things that we do are nothing different, honestly speaking, nothing different from what we would do even when the stock is not on a holiday period. Just that we would prioritize stuff for stocks on a holiday period to ensure that we benefit in a more proactive manner from any such opportunity. So, what do we do with Dr. Lal? Just to give you that example of 3-year long holiday, what were we doing at that time? We spoke to many laboratory managers, as in the many franchisees who would be running in different cities. Few collection centers of Thyrocare. Thyrocare was launching a massive price war. Few collection centers of SRL and few collection centers of Dr. Lal, right? This was typically North India, because at that time, Dr. Lal's footprint was largely in North India. East India was still yet to become big. And players like Metropolis, Vijaya Diagnostics, etc., which you see in the listed universe now, they were not present in North India in a big proportion. So these were the 3 competitors. We tried to understand from the people in the ecosystem, whether they be collection center franchisee managers, franchisee laboratory managers, speaking to doctors who in effect are aware of which lab is doing well in their local geographies, and also speaking to firms such as, say, an Abbott, not the listed entity, but the unlisted entity, which provides reagents and testing material to the diagnostic players. Through all of these checks, what we figured out was that whilst Thyrocare has put its dengue test at some 80 rupees versus Dr. Lal's 200 rupee, and there's a massive price war out there, customer footfall is still is sticking with Dr. Lal, and Dr. Lal is expanding its footprint only because it is offering a faster turnaround time to the customer than Thyrocare, which matters more to the customer than just a cheaper price. And Dr. Lal is running a hub and spoke model to build its brand presence, to build the pull of the footfalls, rather than many of its competitors who were sort of giving something called as cuts to the doctors in order to incentivize the doctor to push the patients to go to their labs, right? Dr. Lal was not doing any of that in North India at that time, and that gave us a conviction that, look, if Dr. Lal is getting the volume of footfalls and the network expansion without bribing or incentivizing the medical fraternity, right, then there is obviously nothing we should be too worried about. There is no lack of pricing power here with Dr. Lal. Market share is maintained and growing, and the share price performance is probably because of non-fundamental factors.
I think there's this, Rakshit, let me just use a cricket analogy to explain this. So folks, if we believe that say Cheteshwar Pujara is fundamentally a good player, right? He's had a couple of bad tours, but he's fundamentally a good player. When we see that he's having a bad run of form, right? In the Purana Din 80s, the selectors would drop a Pujara, saying he's had a couple of bad tours. We can't deal with a player like this. Let's just drop him. In the last decade or so, what the Indian team management has done is what Rakshit is talking about doing to stocks. Right? The Indian team management says this is fundamentally a high-class player. He's delivered for India for a long period of time. So rather than dropping him, let's send him on an India A tour. Or in the case of Pujara, send him to play county cricket. Send him on a tour which will challenge his skills, which will allow him to gauge, which will allow us to gauge whether he's actually a consistent compounder, or was his past performance an aberration, right? Was he just lucky in the past, or is he actually a consistent? We've seen the BCCI do this quite regularly now in the last few years, where rather than dropping a high-class player, rather than churning the portfolio, they say, let's carry on having faith, monitor the player. Rakshit's analogy here is doing more channel checks, talking to competitors, talking to labs, because we can see that this is fundamentally a high-class compounding machine. And just as in cricket, so as in investment, if you want to benefit from Rahul Dravid's 15-year compounding at a test average of 55 and a Sachin Tendulkar's 20-year compounding at a test average of 53, you can't say, boss, after every bad series, no, I'll drop you. You know, if you've taken a holiday of a year, I'm sorry, you're out, right? If you had a two or the other perverse way, the way many Indian fund managers think, you played well for two series, Rahul or Sachin, but two good series, up to tera bad series aega, I'll drop you, right? We don't do that sort of nonsense. We know this is a Dravid, we know this is a Sachin, we know this is a legend. This is fundamentally a consistent compounder. We stick with them over long periods of time, low portfolio churn. When they go through compounding holidays, when they go through a lean run of form, you send them on like Cheteshwar Pujara has currently gone to county cricket. You watch them, make sure that whilst they're having a poor run of form, fundamentally their batting skills are intact, and then you benefit from the fact that the holiday will end, and once again Cheteshwar Pujara will score hundreds for India. Once again, all three names on the screen in front of us will compound for us, right? So the holiday is actually a good time for you to do more work, reassess the player's skills, reassess the compounder skills. We've got more than abundant resources as a country, BCCI. The BCCI has got more than abundant resources to check out players' skills, and Marcellus has more than abundant resources to validate that Nestle, Dr. Lal, HDFC Life are indeed powerhouse compounders Dr. Lal, HDFC Bank, Nestle, HDFC Life are powerhouse compounders, and hence the faith. And hence the faith, honestly, without any nerves, right? Our own money, our entirety of our savings is also riding on these portfolios, and we don't really feel nervous about it. We feel very, very reassured that our monies are invested in these companies, and we know that we will get super returns on our portfolio because of the quality of the franchises that you're staring at on the screen.
Thanks, Saurabh. Thanks, Rakshit. So, Saurabh, another query is for you. Vineet is asking, in the increasing interest rate scenario, what is the impact on banks, their balance sheet, their growth, their margins? What's your view on that?
So typically what happens is when you begin a new economic cycle, central bank cuts rates, money market conditions are flush with cash. In that sort of circumstance, right, when the market has lots of liquidity, the weaker lenders and the stronger lenders are on an even footing. Jab market mein lots of liquidity hota hai, even a wholesale market funded bank, wholesale market funded banks kaun se hai? Ratnakar Bank, IndusInd Bank has also high wholesale funding. Ratnakar Bank is very high wholesale funding. Even a wholesale market funded bank ends up having low cost of funds and can give an HDFC Bank, which is a terrific low cost CASA, current and savings account funding franchise. So when the economic cycle begins and the market is flush with the money market is flush with liquidity, the gap in funding cost between strong banks and weak banks isn't as high as it should be. And that's why what's happened 2 days ago is terrific for high quality lenders, right? An HDFC Bank, Kotak Bank, Bajaj Finance, or if we take our Kings of Capital portfolio and Axis Bank, these guys are very strong liability franchises, and therefore as liquidity tightens, the weaker lenders in India will have a disproportionate jump in their cost of funding. Weaker lenders' funding costs will jump far more sharply than HDFC banks will. And as it is, as you can see on the screen, HDFC Bank is as it is pulling away market share hand over fist. If you add up all the private sector lenders in the country plus SBI, the rest of the banking system together hasn't gained as much market share as HDFC Bank has done on both sides of the balance sheet in the last 3 years. And as the RBI tightens liquidity, that market share gains by HDFC Bank should accelerate further, and ditto for a Kotak Bank, which also has a very strong CASA franchise. Indeed, for Axis Bank, which also has a very strong CASA franchise, and for Bajaj Finance, which doesn't have a CASA franchise, it's not a bank, but it has a very strong liability franchise. After HDFC, Bajaj has the strongest liability franchise amongst non-banks in the country. So the men and the boys separate, the women and the girls separate, right? It becomes easier to discern kaun real Bahubali hai as the RBI tightens liquidity, and that's why we are hoping that Shakti Das ji tightens liquidity super fast over the next 6 months, so that Rona aa jaye weak lenders ko.
Thanks, Saurabh. Rakshit, we have few specific queries on individual companies. We can go one by one. The first is on Dr. Lal performance. It has obviously fallen sharply in last couple of quarters. What's your view? Is it because of increasing competition with new players entering, with more hospital opening up, testing in house? What's your view on that?
Right. So it's actually quite the reverse. It's non-fundamental reasons, because when we talk about fundamentals, we can only see incremental strength of Dr. Lal, right, progressively. So let me highlight our reading of the situation at the ground level as the way it is progressing for Dr. Lal as business over the last 12 months. What COVID has done is it has given 3 types of opportunities to Dr. Lal. The first opportunity was to acquire Suburban and expand footprint in West India. Right now, Suburban, before Dr. Lal's acquisition, was not a very efficient franchise, and anybody would be right to say that this was not a This was not a high return on capital employed asset that Dr. Lal has acquired. But Dr. Lal didn't acquire Suburban for the efficiency of the business. They acquired Suburban for the footprint that Suburban already has in the state of Maharashtra, particularly. Right, they've got around 45 odd laboratories and a reasonable enough footprint of market share of footfalls. Where in healthcare, for a Dr. Lal to expand organically into the West and South India, it would have been a very daunting task. It would have been a significant challenge because healthcare is quite a regional concept, right? Trust building takes a very long time, and it's not a short period of time where you can leverage on presence in North and East India and suddenly expand in West and South India, right? So organic would have been very slow burn for Dr. Lal. Here, Suburban was available during the COVID times, and Dr. Lal was holding on to more than 1,000 crores of unutilized cash on the balance sheet, waiting for such an acquisition. And through this acquisition now, I think there'll be massive synergies in terms of, first of all, footprint expansion in West, using Suburban's existing network, and secondly, operating efficiencies, which Dr. Lal is very good at, Suburban hadn't been good at, and we should see benefits of that flowing through. So that's one. The second piece that has happened in the last 12 months is the expansion of tier 2, tier 3 city presence of Dr. Lal through partnership model with mom and pop labs. So effectively what's happening is the mom and pop labs across the country are facing a massive threat from two sides. One, pan-India players such as Dr. Lal, Metropolis, Thyrocare, SRL, etc., increasing their footprint. And secondly, new entrants who are either the pharma companies. I think a couple of pharma companies have announced their interest, have expressed their interest of launching diagnostic firms by saying that, look, we already have some reach with the doctors through our pharma business. Why not we also open laboratories, diagnostics, to capitalize on that reach? What Dr. Lal is saying is that, look, rather than me as Dr. Lal being another source of competition for you mom and pop lab owners, let me partner with you, right? So you become my partner franchisee, where you as a mom and pop lab retain the footfalls, retain the doctor relationship in the local area, and I will give you a wider list of tests on the menu card with shorter turnaround times, because my laboratory network allows you to deliver reports much quicker compared to previously, where these mom and pop labs would have sent couriers of samples to the nearest metro city or tier 1 city, outsourced large laboratory, and deliver the sample results after a couple of days to the customer for high-end tests. Here, Dr. Lal is offering even high-end tests on single-day turnaround time. And the third piece they are offering through the partnership is the customer interface through the mobile app, the website, the report generation in soft copy, so on and so forth. So effectively, mom and pop lab becomes the front end for Dr. Lal with their current footfall market share in the local areas, without facing a significant threat of competition from new entrants. Right, so that's helping Dr. Lal, that's helping some of these franchisees, and hence, in fact, over the last 2 years, when you look at December 21 revenue of Dr. Lal over December 19, non-COVID organic, without Suburban in it, without COVID in it, Dr. Lal's growth has been 17%, Metropolis 0, Thyrocare 0. Right, so these are numbers I'm reading out from the reported results. Dr. Lal 17% annualized growth, Thyrocare 0 and Metropolis 0 over December 19 to December 21. This is market share gain in front of our eyes, which is happening at a much more accelerated pace than what it used to be prior to COVID. Then another piece that Dr. Lal is gradually doing is expand the home sample collection concept in smaller cities, by leveraging on the fact that during the COVID times, smaller cities were forced to experience home sample collection as a concept, which was not facing much of adoption, which was not receiving much of adoption prior to COVID, because people will just pick up their Activa and give their blood and urine sample at the nearby laboratory and come back, and in the evening go and collect the printout of the report from the laboratory and make the payment there, right? So that used to be the standard approach. Now COVID forcefully made these households experience the convenience of home sample collection, and firms such as Dr. Lal are capitalizing on this by investing into infrastructure development around even non-COVID testing with home sample collection, right? No other player is doing it as aggressively as Dr. Lal is. Most other players had home sample collection only for COVID for tier 2, 3, 4 cities. Dr. Lal is head and shoulders above that in investment of infrastructure. So this is what we observe at the ground level: market share gains backed by tangible evidence of how these gains are happening through capital allocation decisions, which keeps us convinced. So we do agree that Dr. Lal has fallen by, I think, 30-35% in the last 3-4 months, and it's one of the weaker performers at the share price level in our portfolio. But we are actually buying more of it. For many of you as clients, you would have seen in your account statements, we bought more of it at some point in the recent past.
Thank you, Rakshit. Another question is on ICICI Lombard. We had recently exited Relaxo and entered ICICI Lombard, even though we have written on the rationale for it in our newsletter. But if you can, quickly touch upon the long-term competitive advantage of ICICI Lombard.
Sure. So ICICI Lombard is actually prudence of underwriting, if I were to summarize it in one statement. Now, to explain it in greater detail, this is a general insurer, right? In general insurance, typically industry-wide combined ratios tend to hover around 100 to 110%, which means most general insurers, they actually lose money on the underwriting front, right? What ICICI Lombard does is, by being prudent, its combined ratios are the lowest. In fact, at many times, it actually makes profit on the underwriting front itself. Right now, beyond the underwriting piece, the next piece is around investment income, which drives the fundamentals of insurance companies, right? So that's the business model, where ICICI Lombard, first of all, contains the combined ratios and delivers underwriting profitability compared to losses for many of the industry participants. It's around their choice of which line of business they want to get into. There would be times when ICICI Lombard will decide to not enter, let's say, crop insurance. There would be times like these when they've sort of expanded into some new lines of business. This timing of entry and exit done once in 3-4 years around lines of businesses, it helps ICICI Lombard actually not chase revenue growth without profits. They chase revenue growth with marginal underwriting profit. So that's the first piece. The second piece is that more than a third of ICICI Lombard's business is motor, right? Motor insurance. That too, bulk of it being private cars, right, and two-wheelers. And in motor insurance, what this firm does by reaching out to the OEMs and ensuring that at the point of sale, ICICI Lombard taps into the customer base in a far more aggressive manner than anybody else. Any of you would have bought cars more recently. Most of you would have got an ICICI Lombard policy with it in the last 2-3 years. It's a phenomenal monopolization of OEM level insurance policy sale to a new customer. And then ICICI Lombard, it tracks the data of behavior on the claims that they receive from the customer base in a far more rigorous manner than anybody else, right? So there will be a lot of tracking on things like no claim bonus before they agree to sort of service a claim, whether no claim bonus really genuinely was deserved or not, as in the previous year, was there a claim or not before they agreed to service a claim, so on and so forth, and issuing policies and prices of issuance of policies on renewal basis, claim history. Most companies which are more sales oriented, right, they don't focus on whether the customer has had a good or bad experience of claims. Without considering that sort of an underwriting piece, most insurance companies are just after getting market share of renewal premiums, right? That's not what ICICI Lombard does, and hence, whether it be the OEM level or renewal, it's a much higher quality of customer base that they end up sitting with, right? So these are some of the competitive advantages. More recently now, in order to accelerate growth, they've made aggressive entry into healthcare, into commercial vehicle insurance, etc. And Exide Life, Bharti AXA was an asset that they acquired over the last couple of years to expand their footprint there as well, and that adds extra muscle to their distribution capabilities going forward. So that's largely the reason
So
why.
let me just throw in my 10 cents there. As I drive in a car which is insured by ICICI Lombard for the last 3 years. Why? Because the Toyota dealership from which I bought the car has been completely monopolized by ICICI Lombard. So many years back, 15 years ago, Rakshit and I used to cover a stock in the UK called Admiral, which was the UK's leading motor insurer, still is actually. In fact, Rakshit was a top 3 insurance analyst in the UK on the back of his insurance coverage, including Admiral. And one of the things we saw there was how Admiral used analytics to build a leadership position in motor insurance. The closest we can see to anybody building leadership in analytics in India, leadership in motor insurance is ILOM. We can't see any other private sector insurer with anything like this set of competencies in motor underwriting and in distribution of policies. And as Arshit said, that's validated by superior profitability. The other interesting area is, as Rakshit mentioned, Bhargav, the CEO, is very aggressively pushing into healthcare. So this afternoon, Tej was doing a primary data call with a large broker. So 5 years ago, the insurance regulator changed the regulations around the brokerage of insurance, and the regulator created something called the POSP, point of sale agent. ILOM is very adeptly using this new regulatory construct to enter health insurance aggressively. They will be challenged by a couple of players there, but basis what our research is suggesting, basis the strengths of this house, we think that they'll do a very good job in health. In motor, they are already the best in the business. A lot of people superficially compare them to other weaker players in motor. We don't think there's any comparison either on profitability or on underwriting strength or on analytics. In health, there are other people ahead of ILOM, but given what we are finding out in our channel checks, we think ILOM has a very good chance of building, if not the largest, perhaps the second largest private sector franchise in health insurance.
Thanks, Saurabh. So next question is on our view of HDFC Bank and HDFC, and will these stocks, would these stocks go on holiday? If we have any view, if till the time you think, I will just cover a few housekeeping stuff. One of the participants have asked, do we have top up? Can we top up? Yes, you can top up. Minimum top up amount is 5 lakh. You can just transfer and give us the funding proof. If you're an existing client, obviously. Also, one of the participants are asking, I'm worried investing entire money lump sum. Can we stagger? Yes, you can stagger. We have STP option whereby your 50 lakhs that you transfer to us will be invested in 5 tranches over 5 months. 10 lakh will be immediately deployed in the market. Balance 40 lakh would be parked in liquid funds, HDFC overnight. And every month on 20th, 10 lakh will be transferred and invested in equity. So 5 months, 5 tranches. And as an investor, you have one option. Suppose market corrects by 10-15%, in next 1 month, and you feel this is the right time to enter or to invest the balance lump sum. You can tell us, and we will deploy the balance money left in the liquid fund. And also, one of the participants have asked, I've already invested with you guys. I want to invest regularly. Is there an SIP plan? Yes, we do have an SIP plan. We will reach out to you. For an existing client, existing investor, they have to sign up for SIP, and every month money will be debited from your bank account and invested in the equity market. So Saurabh, Rakshit, if you can answer, the query on HDFC Bank and HDFC merger. And
do you want to go first?
Sure, sir. So, look, I mean, first and foremost, and I'll talk as HDFC Bank shareholders first. I mean, we are shareholders, our clients are shareholders of HDFC Bank. So, the first and foremost benefit of this is that HDFC Bank so far had a very small market share in home loans. Right, home loans has been probably the smallest part of HDFC Bank's book compared to any other large private sector bank. So because of that, HDFC Bank's retail book, it runs off faster when compared with some of the other larger private sector banks. Now, just to do some rough maths here, in order to grow HDFC Bank's loan book by 20%, HDFC Bank has to disburse around 60-65% of its beginning of the year loan book size during the next 12 months, right? So let's say we're talking about FY23, whatever was the loan book size on 31st March 2022, in the next 12 months, HDFC Bank would have had to disburse 60% of the 31st March 2022 loan book size in order to grow its loan book by 20%. Why is that? Because 40% of the loan book of HDFC Bank runs off every 12 months. Why does it run off so quickly? Because of the absence of home loans. Because of the absence of home loans in the large part of the loan book, the tenure, the tail of the loan book is very short, and hence the rate at which, in effect, I mean, it's like to give you an analogy, in order to drive a car at say 50 kilometers per hour speed, HDFC has to drive it in only the second or third gear, right? Other banks, they drive the same 50 kilometer per hour speed car in fourth gear, and some of them in fifth gear, because they don't have to disburse 60-65% of their loan book in order to deliver 20% loan book growth. They have to only disburse 30% of the loan book in order to grow their loan book by 20%. So addition of home loans as a larger proportion of the loan book for HDFC Bank after the merger, it actually brings in significantly more efficiencies to the sort of machinery of HDFC Bank. So that's the first part. The second part is home loans are also the fastest growing segment of retail loans in the country, right? And because HDFC Bank wasn't doing a large part of it, its market share in home loans was barely, I think, 2% compared to ICICI Bank, Axis Bank, all of them, their market share being 7, 9, 10, 11%. HDFC Bank's market share was 2%, despite the fact that as a bank, it's a much larger bank than any ICICI Bank, Axis Bank, etc. Right? Adding on the home loan portfolio after the merger gives a fillip to the rate at which loan book will compound, because this is the largest, this is the fastest growing segment of retail loans. Right? The next bit is the ability to cross-sell to HDFC Limited customers, 70% of whom don't have HDFC Bank CASA, right? So all the current account, saving accounts of HDFC Limited customers, 70% of them are not with HDFC Bank, right? Now, when the entity has been merged together, the ability to sort of drive CASA through the HDFC Limited customer base is a very good low-hanging fruit available, and low cost of funding like CASA is gold dust for any bank to deliver high margin growth in the years to come. So that's in effect the benefit of the merged entity to HDFC Bank shareholders. And although the most recent reported results and whatever 100 basis points of net interest margin compression because of wholesale book for HDFC Bank growing a little faster, etc., led to the share price reflecting continuation of the holiday period for another couple of months, we're not worried. Saurabh, you want to add something to it?
Rakshit, why don't you just project the newsletter Tej wrote, Tej and Keshav wrote? If you just project the newsletter, and what Rakshit sort of beams of the newsletter. Again, folks, all of this is available free on our website. Just go to marcellus.in and you'll see lucidly laid out the arguments that Rakshit just presented to you. The maths is actually extremely simple. A lot of people complicate things needlessly in our profession. Both entities, HDFC Limited and HDFC Bank, both of them are lenders who make a 2% ROA. 2% ROA in India for lenders of this scale is spectacular. Both are spectacular entities. Just to give you a sense of how spectacular these lenders are, in the last 40 years, HDFC Limited's credit cost has been 2 bips. 2 bips is the ultimate write-off they've suffered on a 40-year portfolio. That is truly spectacular, right? It's a very high quality book. Rakshit also explained to you that HDFC Bank is growing like a rocket, both sides of the balance sheet. And he's also showed you, and the newsletter that he's beaming up will give you more details, that HDFC Bank has gained more share in the last 3 years than the rest of the banking system combined, right? So both entities are 2% ROA entities, which means very profitable. HDFC Bank is growing like a rocket, far faster than any other bank on a 3-year basis. If you merge 2 entities which have 2% ROA, even if you take some amount of acquisition merger cost and some RBI interventions on CRR, PSL, and so on, even then, once you bake in some synergies, you're back to 2% ROA. Two businesses, both of them are 2% ROA. You merge them, you end up back at 2% ROA. Now, the difference is, at the moment, because HDFC Bank doesn't have a mortgage book of any meaningful size, it gears up. HDFC Bank's debt equity is 9 times, right? So 2% ROA multiplied by 9 times debt equity gives you a 17-18% ROE bank. So HDFC Bank today, 2% ROA multiplied by 9 gives you a 17-18% ROE bank. On a mortgage book, once a bank has a mortgage book, the RBI has lower capital adequacy ratios on a mortgage book, and hence post-merger, HDFC Bank should comfortably be able to do 10 times debt equity. So ROA stays the same as today, 2% ROA. We're not assuming any jump in ROA. I think that's a very conservative assumption to say ROA same rahega. You multiply the gearing not by 9 but by 10, because RBI has lower capital adequacy charges on a mortgage book. You end up with a 20% ROE bank, right? So the merged entity will be a more profitable bank on an ROE basis. As Rakshit explained, it will grow faster. And as we've already showed you, the data already shows that in the last 3 years, no other bank has been able to match the growth engine that this bank, right? This is why working in the stock market in India is such a privilege. You're getting giant entities gobbling up massive industries like banking in broad daylight, and you're getting a compounding holiday, which is why these compounding holidays are great opportunities for us to invest money in outstanding franchises which have proven themselves not over 10 years, not over 20 years, over 40 years, they've proven themselves. In fact, day before yesterday, I sold my father's flat in Delhi, which was financed 40 years ago with an HDFC Limited home loan. And over those 40 years, thankfully, my father repaid his loan. But as I said, 2 bips credit cost suggests HDFC Limited has done a spectacular job. So 2 great firms merging. The stock market has pulled back the stock price by 15%. Time to tuck in. Back to you, Rakshit.
Thank you, Saurabh. Rakshit, one of the queries, these companies in which we invest are already large. Do they have enough opportunity to become even bigger? I think we have touched upon in one of our note, and Vikaji also has given example of Asian Paint, which if it continues to compound at 20-25% for next 20 years, it will become $4-5 trillion company. Is it possible?
Right. Okay, so on Asian Paints, I would say valid concern. On the others, this concern is actually not valid. So let me give you some data. So first, companies other than Asian Paints, Dr. Lal Path Labs is 5% of diagnostic industry market share, right? Now, although it is 1/3 of pan-India organized players' market share, organized players have been growing by leaps and bounds, and the 15% of market share of organized is certainly going to go towards 25, 35, 45% market share in the years and decades to come, right? So for a Dr. Lal Path Lab, the ability to grow market share from 5% to a double-digit number and then to a very high double-digit number, this is not difficult, provided it remains a great quality franchise. So the runway is long. Titan is 6% market share in jewelry. Companies such as, say, HDFC Bank, Bajaj Finance, right? Bajaj Finance market share in lending is 2%. HDFC Bank's market share in lending is 9 or 10%, right? When you look at ICICI Lombard, HDFC Life, their market shares are less than 10-15% each in the entire insurance industry, right? In some cases, the market share gain opportunities from PSU banks, PSU insurers, public sector weaker competitors. In other cases, the opportunity to gain market share is from unorganized players, right? Let's say a jewelry, mom and pop labs in diagnostics, Page Industries market share, even in men's innerwear, is only 20%. And if you consider women's innerwear, it's only 8%. If you consider Page Industries as market share in leisure wear, which is half of Page's revenues, it's low single digits, right? So that's the length of the runway in front of all of these companies. It is far from a point where we would be worried about stagnation because of saturation of growth because of saturation in market shares for any of these companies. Now, having said that, as I said, valid comment made on companies such as, say, a Pidilite in white glue, Asian Paints in paints. So Asian Paints is already 50-55% market share for the last 5-6 years in the organized paint industry. Pidilite has been, for the last couple of decades, more than 90% market share of white glue, right? It's a monopoly, Fevicol. And hence, what about these types of companies? So learning from Pidilite first, the answer to this, and I'll explain the answer on Asian Paints. Why has Pidilite not stagnated, despite the fact that even 2 decades ago, its market share had maxed out in Fevicol? Why has the company not stagnated in its revenue growth, right? It is because today, Fevicol is less than a quarter of Pidilite's revenues, right? The remaining 3/4 is something that never existed till 2 decades ago, right? Things such as, say, Dr. Fixit, Roff, all the acquisitions of MC and Steel Grip, etc., that were done 15-17 years ago, organic expansion of fabric adhesive, the home DIY adhesives for art and craft, so on and so forth, right? A variety of things Pidilite has done in the last couple of decades, which have added new revenue growth drivers for this business, and hence have not let the market share in Fevicol become a reason for stagnation in growth, right, of fundamentals. Asian Paints, interestingly, is doing the same. 5 or 6 years ago, you could have argued Asian Paints was only a paint company. Not anymore. Not anymore at all, because putty, primers, waterproofing. These are three products in which Asian Paints has already made it big from being non-existent in these industries till 5-6 years ago, right? More interestingly, now it is transitioning into becoming a service offering, right? Something called Asian Paints Home Decor, Asian Paints Beautiful Home Solution, right? Through a combination of brick and mortar retail format of AP homes, where they've got in-house sanitary ware, in-house modular kitchens, in-house lighting, in-house door frames as offerings, and they are offering it under the retail umbrella of AP homes, and then packaging it up with a service offering of organized architect as a service through Asian Paints Beautiful Home Solutions. For some of you who don't know anything about this, just to highlight some numbers, our rough sense is a high single digit to closer to 10% of current revenues of Asian Paints, if not more than 10%, are being generated from all of these parts of home decor services put together, right? You won't see this in revenue of Sleek and SS, which are reported as two home decor separate categories in their reported results, because some of these sales of services and products actually go directly into the standalone entity of Asian Paints and are not reported separately, right? Sleek and SS are only 4-5% of revenue. There's a lot more that they're already doing. This is more than 10%, right? So the way we see it is Asian Paints is no more just a paint company. 5-6 years ago it was. 10 years down the line, paint will be probably as small as let's say men's innerwear for Page Industries today, which used to be the only thing Page used to do till 2 decades ago. As small as Fevicol is for Pidilite, which used to be the only thing Pidilite used to do till 25 years ago. As small as Bajaj Finance's consumer durables lending, which used to be the only thing Bajaj Finance used to do 10 years ago, right? People used to ask about Bajaj Finance's stagnation of growth because consumer durable lending market share for Bajaj Finance was nearing saturation. It was a valid concern if you didn't look beyond consumer durables, but Bajaj Finance looked beyond consumer durables in a massive way. Today, it's hardly 10% of the overall loan book of Bajaj Finance, right? So that's how these businesses evolve. They don't allocate capital by staying the same old always, right? If the industries within which they operate are relatively smaller or they have become too big in those industries, these businesses, they allocate capital in concentric circles to add on to adjacencies and do more with the same sort of infrastructure to grow beyond the core, right? So that's what Asian Paints, Pidilite, Bajaj Finance's solution to market share saturation related question is.
And thank you, Rakshit. We will just take last query for the day, and I will take it. So one of our participants says, I love Marcellus philosophy. Thank you so much for posting, doing webinars and writing books. And given that you tell us everything, why should we invest with you and not manage it on our own? So answer is very simple. The reason why we write books, we do webinars, we write newsletter, is to tell the world what we are doing, what we are thinking. If anyone has, patience, energy to follow us, I think that's the best way to do, manage your money on your own. But if you're doing, if you're busy in your life, in your professional life, in your business, and you want professionals to manage your money, that's where, our role comes in picture. We will continue to post, we will continue to write, give, share whatever we learn to with all our participants. Thank you so much. Thank you, Saurabh. Thank you, Rakshit.
Thank you. Thanks everybody. Thank you for that talking.
Thank you.